Hello and welcome to the weekly wrap, and what a historical week it's been. In terms of the ECB then, we'll kick things off where they did embark on this highly anticipated and speculated quantitative easing program. In terms of the highlights then, we saw them go for 60 billion per month, which was larger than what a lot of the sources were indicating, which is more around the 50 mark. In addition, on a timeline, very positive as well, they're looking to conduct this program all the way up till September 2016 has been penciled in. And they could even go further than that if their mandated inflation target of 2% is still not being met. This comes in combination with some sweetening of the TLTRO terms, as well as buying maturities out from 2s at the low end to 30s in the longer dated, as well as buying negative yields and even Greek debt by the summer, means that the market is reactive very positively to this QE announcement from Mario Draghi and his other ECB officials. In terms of the fallout of that then, we have seen Euro-dollar lose almost 4 points, so if not more than that now on Friday's session and Thursday combined, as we trade there the lowest since September, November time of 2003. Peripheral markets continue to be supported by the news, particularly Italy and Spain, which are some of the biggest beneficiaries of a QE-type program. And we continue to see record lows as well in terms of European yields. One thing to keep in mind though is the euro does continue to come under selling pressure here at multi-year lows, is that of Euro Swiss. Now in the cross rate we continue to trade below parity, and given the euro weakness, the Swissy does continue to strengthen. Now this is a bad thing for the Swiss National Bank, given the fact that they dropped that cap just last week. They do not want their currency getting any stronger and hurting their export stocks. As such then, we have seen in the Euro-Swiss interest rate futures market that it is now almost fully pricing in another 50 basis points cut from the S&B, so something to keep a very close eye out for next week, because it would be an unscheduled event, as we did see from the S&B just a week ago. Otherwise, taking a look in towards the weekend, here's of course the Greek snap elections. We should have results by late London time on Sunday evening. Most polls and expectations would indicate that the Syriza party will come out on top. That means that Tsipras will be sworn in as PM. He will then pretty much immediately face a confidence vote, as the most likely scenario is that he will not have a majority in terms of all the political votes when they come in. Now what that means is that most expectations, they will fail to form a coalition under Tsipras, which means we'll then go through various attempts, and this could be quite a drawn out event. So although Syriza are likely to get in, the actual conclusion on whether Greece can form a stable government is pretty unknown, but might take a number of weeks before we get to that stage when we have more clarity on the situation. And just to round things off, another historical move that we did see in terms of this week was of course the Bank of Canada. All surveyed 22 economists got it wrong this time, as they were all expecting rates on hold at 1%, but due to the falling oil price and the pressure downwardly that's been putting on inflation, the Bank of Canada decided to trim rates by 25 basis points. That pretty much concludes the whole weekly wrap for me for the moment, so I wish you all a fantastic weekend, and I'll speak to you all again bright and early Monday morning. Thank you.